Today we are reviewing two companies in the same market and explaining how conceptually the liquidity ratio, leverage ratio, profitability ratio, and DuPont analysis can determine which of the two companies is the more successful one. We looked at year 2015 for Walmart and Target, and the liquidity ratio measures a company's ability to pay debt obligations, both current and long term, as they become due. We use current ratio because the current ratio allows us to see how quickly a company can liquidate all their current assets, while quick ratio is broken down even more by seeing how fast they can liquidate quick assets, excluding inventory, into cash. We use cash ratio to see how much money they are using to pay off debt. The higher the percentage, the worse. So current ratio is the short-term debt obligation. Anything over 1 is good. More assets over liabilities. Walmart had 97% while Target has 116%. Quick ratio is how fast the company can convert quick assets, excluding inventory, typically in 90 days, into cash. Walmart had 28% while Target had 46%. Cash ratio, ability to pay off short-term debt, only using cash. Both Walmart and Target had 14%. Inventory days is how long the actual inventory items is in storage before converting it to cash. Walmart had 45 days while Target had 59 days.
Hi. Breaking up of what Amy said, we also found leverage ratio, which measures how much capital comes in the form of debt or loans, and how will they use that debt or loan to create a profit. Time interest earned, ability to meet debt obligations, and how reliable they are when it comes to paying it off. Bad time interest earned could lead to bankruptcy. So fortunately, Walmart had 11.3% and Target had 5.14%. The reason the ROE for Target was down in 2015 was because their net income was negative. Debt ratio is how much of their assets are financed by debt. Walmart had 60% while Target had 66%. The higher the debt to equity ratio, the more they are using their debt to finance their assets.
Okay, so breaking off from what Amy and Vidya said about this, we also went in and found profitability ratios, and I did the DuPont analysis just because I want to see like how much, how profitable both companies are in 2015. So what we went and found is like on this sheet, we pulled up their income statements and their balance sheets, and then they give us the financial ratios for gross profit margin, operating profit margin. That's not what I wanted. That's okay though. And here's a chart if you want to see a graph. But anyway, we found the gross profit margin. That just basically tells us like how much money is left over after we've taken account cost of goods sold. Because like from the income statement, we can go from their net income, take out the cost of goods sold, and then gross profit just shows us how much money they're left over after that. And then from gross profit, we're going to go down to operating profit margin. And with operating profit margin, we get to see more in depth of how much money they have, because we're from operating profit margin, we're taking account like the expenses that and like salaries paid and everything of what they're making. So that gives us a better synopsis of how much the company is making after they've paid their expenses, after they have paid their wages to their employees and all that stuff. And from there, after that, we also found their ROE, which I think is the most important profitability ratio, because it's important to see how much equity they're getting back from what they've paid. So for when we were looking at Walmart's, on the screen up there, they had given us Walmart and Target's ROE. So Walmart's was 20%, while Target's was down 5%. So like theirs was negative 5% for 2015, which is not good. I think it's terrible, because for that year they're losing a lot of money, a lot of return on their equity. So to break that down further, because I wanted to see why their ROE was worse, was what I did their DuPont analysis. So with their DuPont analysis, I looked at their net profit margin, their total asset turnover, and like their debt ratio. So I looked at like exactly why it was going down. So with the net profit margin, it was for Walmart, the number was 3.37, while Target's was negative 2.25. So the reason theirs was negative 2.25 was because their net income, because when you calculate that net profit margin, their net income for 2015 was negative. Like Target's was like, so we're not in the same setting, so we got kicked out of the last room. So we came with the bookshelves. I checked out a lot of finance books. That's why there's nothing back here. But as I was saying, not from I did net profit margin. Now I was doing the DuPont analysis, right? So I talked about the net profit margin. Now for the total asset turnover, so we watch, like, the reason we look at the total asset turnover too is to see how much, like, their assets are coming back every year when they're selling off their assets, and what their turnover ratio is with those assets. So with a company like Walmart and Target, they're not asset intensive, right? So they get their assets and they try to sell them off as quickly as they possibly can, because they're not going to make business by retaining all of their assets. So for Walmart, their total asset turnover was 2.39, and for Target it was 1.76, which is to be expected because their asset turnover ratio is really fast. They got to keep going, selling all those things. And the last thing was, like, their debt ratio, like their debt to equity. So both of those for them was, like, when I found it was like 60% for Walmart and 66% for Target. So that means a lot of their debt, or a lot of their assets, are funded by debt. So all the loans they bring in, or anything that they get from banks or anything, they go straight into the asset. So then they get the turnover ratio on there. It's going to be high because a lot of it is funded that way. So that's the reason I found the DuPont analysis, just to see why the ROE was negative for Target and why it was positive for Walmart, just to see that. So, like, after we did all this analysis, we found that both of the companies are, of course, they're asset intensive, and they want to get rid of that inventory as fast as they can. And then after doing all this, we think Walmart was way more successful than Target for 2015, obviously, because their net income was way higher, and by looking at all these ratios, I can say that Walmart is better than Target in 2015.